we're going to talk a little bit about investment properties. And I just wanted to give you a few kind of basics for evaluating a rental property investment. The first rule to keep in mind is that you really make your money when you buy. Okay. A lot of what determines your investment return is how much you pay for the property. And everyone says location, location, location. But you know what? When it comes to your investment return, price, price, price is probably at least as important as location, location, location. If you overpay for something, you're just not going to have a very good return. Not only do you have less protection if it goes down in value, but there's less, difference between what you sell it for and what you bought it for when you go to sell in a few years. So always try to get a good price on the property. You're not buying a place that you and your kids are going to live in, right? You're buying a place by the numbers. It's got to make financial sense or don't buy it in the first place. Okay, the second rule is what I call the 55% rule. Okay, and use this to determine your net operating income, your NOI, probably the most important number for a direct real estate investor. That's basically what's left after paying all your expenses, not including the mortgage. Okay, so basically, you need to think about 55%. And what that is what's left after you pay all the expenses of owning, right? The expenses of owning are 45%. There are things like vacancies, insurance, maintenance, property taxes, snow removal, lawn maintenance, repairs, and management costs. Whether it's your time doing that management or whether you're paying somebody else to do it, it's really the same thing. Okay, so if that's 45%, you only get 55% of the rent to cover the mortgage and your profit. So if that doesn't cover the mortgage, you're going to have a negative cash flow situation. Now, expenses vary, right? This is just a rule of thumb, but that's something to keep in mind. If 55% of what you're collecting in rent is not more than your mortgage payment, you're probably going to be in a cash flow negative situation. You don't want to be in that. Now, while a doctor income might be able to carry one or two properties that are cash flow negative, you can't carry an infinite number of them. You need cash flow positivity. All right, the third rule is to use the capitalization rate to compare one property to another. Once you know what the capitalization rate is in your area at that period of time for that type of property, then it's a lot easier to compare one property to another, right? Think of the cap rate as like the equivalent of a stock dividend. While the property is likely to increase in value at about the rate of inflation, the net operating income is really what's going to provide most of your investment return, both as cash flow and as amortization on the mortgage that you might have on the property. So, if you have a 6% cap rate property, capitalization rate really is what you would get in cash flow on the property if it were paid off. If it's a $100,000 property and you get 6% on it, that's a cap rate six, $6,000 in cash flow from it. But if you're getting 6% cap rate property, inflation is 3% and appreciates by that, your return's 9%. If you have a little bit of leverage on it, you might get a little higher than that. Obviously, there's risks that come with leverage. All right, rule number 4, you got to put down a significant down payment if you want positive cash flow. Okay, whether that down payment is in the form of sweat equity, whether that down payment is the form of getting an absolute steal on buying the property, or more likely just cash that you put down when you buy it. That's the key to positive cash flow. When you've got a debt to income or debt to value ratio of 90%, you're probably not cash flow positive. It's got to be better than that. Typically, you can have 25% equity in there, 30%, 33% equity. That's the sort of range it takes for most rental properties to have positive cash flow. It's maybe even a little worse these days as interest rates have gone up. But expect to put money down. These no money down deals, yes, they can be done, but they are often negative cash flow properties, and you don't want that. And then the last rule is to minimize your transaction costs, right? One of the most significant downsides of real estate investing is it just costs a lot to get in and out of a house. I tell people that are buying houses, to live in, that their transaction costs are probably 15% round trip, 5% to get in, 10% to get out. And that's pretty true. So $200,000 property, that's going to cost you $300,000 or $30,000 round trip. $500,000 property, right? That's going to cost you $75,000 round trip. So you want to minimize those as much as you can. Sometimes becoming a realtor, so you can be, you don't have to pay a realtor. That can really minimize your transaction costs. Everything you can possibly do to reduce those increases your investment return. Hope that's helpful to you.
The hosts of The White Coat Investor are not licensed accountants, attorneys, or financial advisors. This podcast is for your entertainment and information only. It should not be considered professional or personalized financial advice. You should consult the appropriate professional for specific advice relating to your situation.